In today's video, we're unpacking the U.S. regional banking crisis of 2023, a financial turmoil that sent shockwaves through local economies and raised questions about the stability of smaller financial institutions. What caused this crisis? How did it impact individuals, businesses, and the broader economy? And what lessons can we learn to prevent similar crises in the future? Let's break it all down. What led to the banking crisis? The U.S. regional banking crisis of 2023 didn't happen overnight. It was the result of several converging factors. 1. Rising interest rates. To combat inflation, the Federal Reserve raised interest rates at an unprecedented pace. 1. While this was necessary to stabilize prices, it significantly devalued long-term assets held by banks, such as government bonds. 2. Mismanagement of risk. Many regional banks had a high concentration of deposits from specific industries, such as tech startups or real estate. 2. When these sectors faced downturns, it triggered liquidity issues. 3. Loss of confidence. A few high-profile bank failures, like Silicon Valley Bank and First Republic Bank, sparked fear among depositors. 3. Social media amplified the panic, leading to bank runs. 4. Regulatory gaps. Unlike larger banks, some regional institutions operated with less stringent oversight, making them more vulnerable to shocks. These factors created a domino effect, where one bank's failure rattled confidence across the entire sector. The domino effect. The crisis began with a few banks struggling but quickly spread across the regional banking sector. 1. Silicon Valley Bank, SVB. One of the first major casualties, SVB collapsed after a failed attempt to raise capital. 1. Its downfall was fueled by its overexposure to tech companies and poorly timed investments in government bonds. 2. Signature Bank. Shortly after SVB, Signature Bank faced a similar fate, driven by depositor panic and liquidity issues. 3. First Republic Bank. Despite efforts to rescue it, First Republic's collapse sent shockwaves through the financial system. These failures had a chilling effect on the broader market, with regional bank stocks plummeting and customers moving their funds to larger, perceived, safer institutions. Impact on individuals and businesses. The crisis didn't just impact the banks. It had far-reaching consequences for individuals and businesses. 1. Small businesses. Many small businesses rely on regional banks for loans. 1. As these banks struggled, businesses faced challenges accessing credit, stalling growth and expansion plans. 2. Depositors. While most deposits were insured up to $250,000 by the FDIC, those with higher balances faced uncertainty, leading to panic withdrawals. This crisis reminded us of how closely intertwined the banking system is with the lives of ordinary people. Government and industry response. The U.S. government and regulators acted swiftly to contain the crisis. 1. Emergency measures. The Federal Reserve created a Bank Term Funding Program, BTFP, to provide liquidity to struggling banks, ensuring they could meet depositor withdrawals. 2. FDIC intervention. The FDIC stepped in to secure deposits, even covering uninsured amounts in some cases to prevent further panic. 3. Mergers and acquisitions. Larger banks acquired struggling regional banks, such as J.P. Morgan Chase taking over First Republic Bank, to stabilize the system. While these actions prevented a full-blown financial meltdown, they also sparked debates about the moral hazard of bailing out poorly managed banks. Lessons learned. The 2023 regional banking crisis has taught us several important lessons. 1. The importance of risk management. Banks need to better manage interest rate risk and diversify their deposit base to avoid over-reliance on specific industries. 2. Stronger regulation. The crisis highlighted gaps in oversight for regional banks. 2. Calls for enhanced regulation, similar to what applies to larger banks, are growing. 3. Transparency matters. Clear communication from banks and regulators can help reduce panic and prevent bank runs. 4. Financial literacy. Educating depositors on topics like FDIC insurance can help mitigate unnecessary fear during times of uncertainty. These lessons are vital to building a more resilient financial system in the future. The U.S. regional banking crisis of 2023 was a stark reminder of how fragile the financial system can be. While the immediate fallout has been contained, the crisis exposed vulnerabilities that must be addressed to safeguard our economy. What do you think about the response to this crisis? Are we doing enough to ensure stability, or is there more work to be done? Let us know in the comments. If you found this video helpful, please like, subscribe, and hit the bell icon for more insights into financial events and their impacts. Thanks for watching, and we'll see you in the next video.